if someone sends them to you, or what's the best? Yeah, I'm pretty sure. Yeah. Yeah, should we try that? Can you send me an email, and then I'll have your email address, saul.doc@jpmorgan, and I'll reply to it. Thank you. Cheers. Bye. Hi, Dmitry, it's Saul. Is Morris here? Okay. Can you go into... I need you to send me the presentations, actually, because they've messed up. So, if you open the folder... yeah, the Imperial one, what's on... Make sure it's shared drive. Okay. I need 3 and 4, which is CDS indices and CDS options. So 4 and 5. 4 and 5. Indices and options, yeah. Can you send those to me? No, PDFs. Yeah. As soon as there should be a PDF folder here. Can you just double check that the PDFs are there? And I need it now. Okay, thank you. We're going to be another 5 minutes because unfortunately the PDFs that have been uploaded don't seem to be in the right format. So I apologise for that, but we are hopefully getting the right ones up soon. Hi Robin, it's Saul here again. Did that work? Yeah, I mean it's opening as well, it's saving it. Can you maybe try to change the name of the file? Will that work? But if you should change the name, it might be because it's got like a plus there or something that's funny in the name. Okay. Can you print it, maybe print it to PDF and try and do it that way? I mean, or, I mean can you, if I send you like a PowerPoint, will that work? Okay, let me try PowerPoint. Okay. Can you send me the PowerPoint as well, please? All right. In the interest of time, we're going to try and do it a bit old school. So I've got my printout of the presentation in front of me. It is going to be projected up onto the screens in front of you. I hope you can see that. But the actual presentation, the PDF itself will be up on the hub when the technology gets up and running. So apologies for that. Anyway, why don't we start and see how this goes. So welcome everyone. Today's lecture is going to be on CDS indices. Yes.
I think it's on the hub already.
Oh, is it?
I think we uploaded it, yeah.
Yeah, but it's not that version. Is that version working?
Part 4 and part 5.
There's a new one. Okay, thank you. There we go. Okay, thank you. That's super. All right, let's do it. Thank you. Saved. So today we're going to talk about CDS indices and CDS options. We started off talking about single name CDS, how the product worked. Moritz last week spoke to you about some more stuff on single names. So how do we trade kind of single names in terms of the curve? Also, how do we look at single names versus bonds? And today we're going to kind of actually start to talk about some of the liquid products we trade, and in particular the iTraxx and CDX indices. So these are basically kind of the most liquid product in the credit market out there. If anyone trades corporate bonds, and if they're looking at it from a kind of macro perspective, then they're actually trading the CDS indices themselves. And that includes people who trade directly in the credit markets themselves, as well as kind of equity investors, rates investors, people looking for sort of cross-market opportunities. But these things kind of trade, on a daily basis. We're probably trading around about 70 to 100 billion worth of notional in across the kind of global suite of CDS indices. So what is the CDS index? Basically, a CDS index is effectively a basket of single name CDS. Okay, so when you think about the index itself, what you are buying when you buy protection through the index, or when you sell protection through the index, is exposure to all of the names in the underlying portfolio. So it's as if, rather than going and selling protection, let's say on 125 single name trades individually, you just did a single trade which basically gave you that exposure. Okay, so it's as if you do a single trade, which basically is a basket of those CDS contracts. So in Europe, we have the iTraxx main. That's kind of the most liquid index. It's 125 single name CDS. They start off as investment grade CDS. They kind of transition through time. They may be downgraded over that period. And your exposure to each individual name is 1/125th. Okay, so you have 0.8% of your notional in each single name, as if you'd sold CDS protection on that. It's very liquid, as I mentioned. Bid-ask spreads are very tight. So the bid-ask on pardon me, the iTraxx main, bid-ask on a typical corporate bond can be somewhere between 2 to 5 basis points. On a CDS trade, which is often much bigger in size as well, your bid-ask is probably kind of an 1/8 to 1/4 of a basis point. So, very liquid and very highly traded. what is the kind of global suite of indices that we trade? So we've kind of shown them up here. In Europe, we trade the iTraxx Main. We trade the Sub and Senior Financials Index. I'll talk about those as well. They are sort of subsets of the iTraxx Main itself. We used to trade something called High Vol. High Vol was basically the highest spread names in the index. That one's kind of fallen by the wayside, so we don't really trade that. There are a few kind of hereditary positions. iTraxx Crossover. So iTraxx Crossover is the high yield index in Europe. So it's called Crossover because when the index started back in 2004, the names that were entering it tended to be kind of crossover. So they were kind of downgrading or being, transitioning from IG into high yield. They were kind of on the cusp, so they were kind of called crossover names. The index was called Crossover, but today it's very much a high yield index. So the average kind of rating on that is probably around kind of single B flat in terms of the risk that it has. In the US, they trade the CDX-IG. That's kind of the equivalent of the iTraxx Main, 125 investment grade names. They also have the CDX High Yield, which is a high yield index, the equivalent of the Crossover, but focusing on US names. In sovereign space, we trade SOVX Samir, we trade SOVX Asia, we used to trade SOVX Western Europe, which was essentially Western European sovereign CDS in an index. That had a lot of traction back in kind of 2010, 2012. But restrictions or EU restrictions on trading European sovereign CDS has kind of meant that that one has sort of fallen by the wayside. In Asia, we trade iTraxx Japan, Asia ex-Japan, iTraxx Australia, and then on the EM side, CDX EM and CDX LATAM as well. So as you can kind of see, there's kind of like a CDS index to suit your different kind of global macro view, and depending on what kind of index or area you are trying to focus on. And essentially what we've tried to do, or what the market has tried to do, is kind of focus on these single name products as the most liquid ones out there. So, what is the iTraxx Main? As I mentioned, 125 single name CDS contracts equally weighted. 125 names in the portfolio, 0.8% exposure to each name. The sector constraints are, 30 autos, 30 consumers, 25 consumers, 30 financials, etc., etc. So these are kind of kept constant through time. So there's always 30 financials in the index. The actual financials that those might be, however, change through times. Back in the day when the index kind of starts off, we used to trade each of these subsectors as an individual index as well, but today we basically only trade the financials index itself. Constituents in order to enter need to be investment grade. Investment grade basically means BBB minus or higher. If they're BBB minus on sort of negative watch or negative outlook, then they're eligible for the crossover index, and that means that they're no longer eligible for the IG index itself. The tenors that are traded, most of the trades go on at the 5-year. So remember, as we sort of spoke about earlier on, you do a trade, it starts off as 5 years and 3 months, it kind of rolls down through time. When 6 months has passed, we have an index roll, which means that you can choose to roll into the new series. But if you don't do anything, you basically stick with your original trade. So 5-year is kind of the liquid point, but we trade 3-year, we trade 7-year, we trade 10-year. And all of the indices, in order to kind of encourage liquidity, trade on an upfront plus 100 basis point basis. So your coupon is always in the iTraxx Main 100 basis points. So if the index spread is below 100 basis points and you're a buyer of protection, you're basically going to receive an upfront in order to enter that contract, because your coupon is going to be 100 basis points and you're going to pay that over the life of the contract. So although it's quoted in a spread term, the price is what you pay up front, and that's based on a 100 basis point coupon. Liquidity, as I mentioned, in Main is probably about 25 to 30 billion on a daily basis. And then the crossover index is kind of the equivalent of Main, but focusing on the high yield universe. That is 75 single name CDS contracts. So main has 125, crossover has 75, and we don't have the kind of sector constraints that we have in the main index. So basically anything that is kind of high yield and has a CDS trades in that index. Again, we don't really have financials in that index, so it's very much kind of a corporate bond index focusing on the high yield space. And these indices, we'll look at it in a second, roll every 6 months, but they tend to have the kind of most liquid names coming in and out of the product. So spread histories of the iTraxx indices goes back to 2004. Prior to that, there were some CDS indices around. There was something called TrackX, I believe, before iTraxx. There was also something called Jesse a long time ago. But these charts basically give you a bit of a sense of kind of like, the spread history of these indices. So started trading back in 2004, iTraxx main series 1, basically trading with a spread of around about kind of 40, 50 basis points. That kind of tended to move a lot tighter. 2005, as you can see, the index kind of blew out a bit. You had a little bit of a spike in spreads. That was on the back of sort of GM and Ford, some of the autos being downgraded. Then you kind of flatline again. We went down probably in iTraxx main. I think the lowest spreads hit back in 2007 at that low point were about 18 basis points, maybe 18 and a quarter or something like that. And then you actually got a kind of quite rapid spread move up on the back of some of the Bear Stearns funds defaulting. Spreads kind of came back down, and then you got the kind of 08 financial crisis going into 2009. Spreads at their wides reached, what was it, like 250 or 200 basis points. And then they've kind of come back down again. You had the sovereign crisis in 2011, 2012. Spreads go up again, then they kind of start settling back down. And then recently, end of 2015, you had the sort of global growth slowdown concerns over commodities, concerns over the US, concerns over China. And now spreads have kind of sort of settled back down following that, and around about sort of 50, 60 basis points type of area. So what you can see over here is kind of like a continuous time series of spreads. What we will see in a second is that this is not just like a single product, but actually a kind of index that rolls every 6 months. So this is kind of the history of the on-the-run index, the history of the sort of on-the-run spread at each point in time. On the top is main, on the bottom is crossover. They tend to be relatively well correlated with each other. Spreads moving wider in main tends to be spreads moving wider in crossover as well, but people do trade the kind of differential between those two as well. And roughly speaking, the beta or the spread ratio is about sort of 4 times if you're looking at crossover versus main. The next indices that we trade in a liquid form in Europe are the iTraxx senior financials and the iTraxx sub-financials. The senior financials is basically the 30 financials that are in the iTraxx main index. So the index has 95 non-financials, it has 30 financials, and those are the ones that are in here. When we talk about financials, we mean both banks and insurance companies. So there's around about 20 banks and probably kind of like 10 insurance. And those are the names that come into these indices themselves. And then the sub-financials is basically the same names that are in the iTraxx senior financials, but they're subordinated debt. So what is subordinated debt? Subordinated debt, basically for the purposes here, means lower tier 2 debt. So banks, whilst corporates do issue senior and subordinated debt, it's not very common. Banks, on the other hand, because of kind of regulatory requirements, have a tranche of senior debt and then a tranche of subordinated debt. So they have kind of regulatory requirements. That means that they have to basically have subordinated debt. And that's basically the debt that's traded over here. So when we have sub-CDS, what we actually mean is lower tier 2 CDS, because you can't deliver anything more subordinated. So equity tier 1 is not deliverables for sub-CDS. And it basically reflects anything that's kind of of that subordinated tier 2 reference different entity. We don't tend to trade kind of 3 and 7 year. Most of the liquidity again is on the 5 year, but we also do some sort of 10-year trades. And again, the coupons on these indices are both 100. I guess one thing I should have mentioned, I suppose, is it there? Yeah, the bottom. The iTraxx crossover trades with a 500 basis point coupon. So pretty much all the indices in Europe trade with 100 basis points as the fixed coupon, but the crossover, because it's a high yield index, trades there. If you look at the kind of spread history, again, similar pattern to what we were seeing before. The red line is the sub-fins, the blue line is the senior financials, and again, you kind of, people trade senior versus sub, taking a view on whether senior is safer, whether subordinated is safer, and historically, they've tended to trade around about a basis of kind of two times. So senior, has tended to trade around to the 2 times versus where the sub is. Back in 2014. There was a change to the CDS contracts. We had the 2014 CDS definitions, and that meant that the indices that started subsequent to that, so any index that started trading basically around sort of October 2014, has a different, not just like a different composition, but actually a different CDS contract. Okay? Now, as you can see, there was a bit of like a jump in that time series back in 2014. So when you were looking at the ratio, the subordinated CDS basically widened out a lot more, or at least the new index names were a lot wider than they previously were. The reason that you see that kind of jump from sort of a ratio of like 2 times to about 2.5 times was that the CDS contracts were changed back in 2014 to basically make them a bit more kind of in line with what was going on in the market. So again, we'll kind of talk about it later on, but there were a couple of events, particularly with a company called SNS, which was a Dutch bank, where basically the government, the Dutch government, took your subordinated tier 2 bonds away from you. Okay, so you had a subordinated tier 2 bond, and on Monday when you went to look in your locker, it was no longer there because the government basically expropriated that bond. Now CDS needs a deliverable in order to settle. So when you have a CDS trigger, when you say these bonds are worth 20 cents, you kind of have to deliver those bonds to your counterparty in order to get your par amount. Okay? But the problem over here was that those bonds never existed or didn't exist anymore. So you couldn't actually deliver them to your counterparty in order to receive par because you couldn't deliver anything. When you looked in your locker, there was basically a letter that said you have a right to come and, hear your case in The Hague, where you will be told you will get nothing. So basically, because you couldn't deliver the bonds into the contract, there was no CDS settlement, and effectively the contract didn't work. So we had new definitions, and those new definitions now basically allow you to deliver sort of nothing into the contract. And again, that's kind of a special case for some of the financials, particularly on the subordinated side. Again, let's won't focus on that too much, but we will kind of talk about that later. But that does explain why we've got that kind of discontinuity in the data over there. So CDX IG. So in Europe we call them iTraxx. In the US, CDX. Basically, CDX IG is effectively the same as iTraxx Main. So all of the stuff that we've kind of spoken about for iTraxx Main, basically exactly the same for CDX IG. They don't tend to have the sort of sector constraints that we have in Europe. So they kind of allow any companies in, also equally weighted, but there are 125 North American, so 125 US domiciled corporates rather than iTraxx, which is 125 European corporates. The other thing that's slightly different between the two indices is that the CDX IG tends to have much fewer banks in the index. The reason for that was when these indices kind of started off trading, many of the dealers themselves the dealers were banks, and in order not to kind of incorporate the dealers into the index itself, because people felt that it would be kind of doubling up the risk. So for example, JP Morgan selling index protection when JP Morgan is a member of the index itself was felt to be kind of doubling up on the risk. So one of the rules that was basically we won't have any, we won't have the kind of dealers in the index. That's kind of stuck. So European indices have more financials, and again, when people kind of are trading financials, they tend to trade it on the European side rather than on the US side. CDX high yield, as I mentioned, is kind of the equivalent of crossover. Crossover has 75 names. CDX high yield has 100 names. So the exposure of each name in crossover is like 1.25. The exposure of each name in high yield is 1%. Again, these are kind of US corporates. The other thing is, it also trades with a 500 basis point coupon. And the other thing to kind of note is that it is the only index that basically trades in price terms. So when you see a quote for CDX high yield, it will basically be a price like 101.25. Okay, so it's not a spread, it's a price. Okay, and how do we arrive at the price? Essentially, the price is 100 minus the upfront. So it's kind of as if you were buying a bond. So the price of CDX high yield is kind of the price of a bond with a 500 basis point coupon. So, let's just take a sort of simple example. Imagine the coupon's 500 basis points, CDX high yield index spread is 400 basis points. So there's a 100 basis point differential between the traded spread and the coupon. So the buyer of protection is basically going to be, or so we say the seller of protection has to effectively pay 100 basis points times the duration of, let's call it 4.5. Okay, so it's going to be 4.5 points up front. So the price of the index is basically going to be quoted as 100 plus 4.5, so 104.5 as a price. So it's as if you're buying a bond at 104.5, and you're basically receiving this 5% coupon over the terms. So just to kind of be aware, it is the only index that kind of trades in this slightly unusual form, but the spread, people still tend to kind of look at the equivalent spread and what that means. And again, when we look at the sort of CDX high yield and the CDX IG indices, you kind of see a very similar, macro pattern to what we kind of saw before. CDX IG did reach, close to 300 basis points during the crisis. Or the 08-09 period, and high yield got all the way to kind of 2,000 basis points. So if you had picked the right point over there, you basically got a 20% annual yield roughly if you had done that trade, which would have been quite nice. All right. So CDS, some of the kind of mechanics around the CDS product itself. So as I said before, indices are kind of quoted and traded in the same day as a single name. So rather than buying protection on XYZ Corp, you're basically buying protection on the iTraxx index, and that basically has all of the underlying names in it. It's traded or quoted, so we say, on a spread basis, and then the usual formulas that we looked at earlier are used to calculate the upfront amount which is paid. I think we've kind of spoken through all of these things before, but if you do want to go and have a look, there is a website, there is the website cdsmodels.com, cdsmodel.com, and that basically allows you to kind of get a sort of standard upfront model which allows you to convert from upfronts into running spreads and so forth. One thing I've kind of mentioned a little bit but we haven't kind of gone into is iTraxx series. So I apologize here because this slide was actually not updated from last year. So you have to kind of fast forward a little bit. But we basically are now trading iTraxx Series 29. Okay, so last year we were trading iTraxx Series 27. This time we're trading iTraxx Series 29. What does that mean? So essentially each 6 months just like we spoke about sort of single names rolling, where if you have a single name CDS contract, you kind of have the right to extend maturity, sell out of your old contract and buy into a new contract. The iTraxx indices have a roll every 6 months as well. So if you bought protection today on iTraxx S29, Series 29, your maturity at inception, which was in March 2018, was 5 years and 3 months. Okay? So it took you to June 2023. Okay? As we get to September of this year, we're going to keep trading iTraxx S29 as the on the run, but at that point in September 2018, some of the names in the portfolio would have been downgraded, and also the portfolio duration is not quite 5 years, it's 4 years and 9 months at that point. So what we do is we have what we call an index roll. An index roll basically means we kind of rejig the portfolio, so we kind of take out the names that have been downgraded, we put in some names that have been upgraded, and we extend the maturity of the index. Okay? So you'll then go to a December 2023 as your index, but you'll also have a slightly different composition because you've kind of got rid of the downgraded names and put in the new names. Now, when you do your trades today, you are always going to stick on the S29. Okay? So you don't change. Nothing like forces you to change. However, when you get to September this year, S30 is going to start to trade. So there will be like a new on-the-run index, and you have the right, if you want to kind of roll out of your position and roll into the new position. So basically every 6 months, we kind of have a new index. You know, S21, S29 at the moment, S30 in September time, and that becomes like a new sort of, you know, high grade, 5 years, 3 months contract, and that kind of becomes the one that's sort of liquidly traded in the market. The off-the-run indices still trade, but they, you know, are not sort of the focus, and everyone kind of tends to focus on the new index. So, you know, iTraxx S1 was the index we started trading in 2004, and now we're all the way up to iTraxx S29. CDX IG has a slightly, I think they rolled at a slightly different point. So in Europe, they're actually, in the US, they're actually on CDX S30, even though in Europe we're on iTraxx S29. And also, you know, the roll tends to be the 20th of September and the 20th of March, with a 20th of June or December expiry, but every now and again the kind of roll gets delayed for whatever reason. It doesn't always happen on the 20th. There have been a couple of cases when it's kind of been a couple of weeks later after that. So how do we think about CDS indices? As I mentioned before, when you think of the index, it's different to like an equity index, okay? So when you look at the FTSE is basically just like, some sort of weighted average of the underlying equities themselves, okay? You can't actually like buy the FTSE, okay? If you wanted to buy the FTSE, the only way you buy the FTSE is you basically go out there and like get someone to execute a portfolio trade for you, or you buy an ETF that sort of references the FTSE, or you buy some sort of future that references the FTSE, or you do something along those lines. In the credit world, when we talk about the indices, we're actually talking about like a physical product that you trade. So when you trade iTraxx, you're not just like trading some like thing that references these 100, like you are actually trading 125 single name CDS, but you're doing it through a single trade. Okay? So when you have a credit event on a given name, you're basically just going to have a gain or a loss relative to the proportion that that name is of your portfolio. So iTraxx Main, as I mentioned, has 125 names in the portfolio. So your notional exposure to each name is 1 over 125, so 0.8%. So if there is a credit event, okay, and let's say there is a recovery rate of, I don't know, what have we done here? I don't know, let's call it 20%, okay? So you've got a recovery rate of 20% on your single name. What is kind of the loss Well, the loss is then going to be 0.8 times 1 minus 20%. Okay, so your loss of your notional is going to be 0.64, is it? Yeah, so 0.64% is basically going to be the loss that you're going to experience. 0.64, right? Yeah, 0.64%. So basically, it's going to be 80% loss on 0.8 of the portfolio. That name then is basically gone. So not only do you no longer have exposure to that name because it's had its credit event, but you no longer receive the coupon from that name as well. So the coupon on the index, the 100 basis point coupon, goes down by 0.8% as well. So you kind of have this loss from the name, and then you actually have a loss of your coupon because you're no longer experiencing the coupon from that. So it's exactly the same. The dynamics of it are exactly the same as if you had sold protection on that name, and then it no longer exists. So based on this, we can kind of think about. The important thing, however, is that the index trades on its own. So we kind of know what it is, but it trades with a single spread, which doesn't necessarily reflect the spread of the underlying names in the portfolio. So what we can do, or what we have, is what we call kind of the theoretical spread in the portfolio. Okay? What is the theoretical spread of the portfolio? Well, the theoretical spread of the portfolio is basically, some kind of weighted average of the underlying names in the portfolio. Right? So if you were to sell protection on each of these names at the spread that was traded in the market, you'd basically be able to kind of come up with a spread of the underlying index itself. And the difference between that theoretical level, which is kind of if I went into the market and bought protection, what level would I get for that spread, versus the actual traded level, is what we call the basis to theoretical. Sometimes people call it the skew, sometimes they call it the basis, depending on, we tend to try and call the basis to theoretical, so it's kind of different to the basis to cash, it's different to the, any other basis, but basically it's the difference between the index spread and the theoretical spread. So your first guess at how you might calculate that theoretical spread is basically going to be, well, it's just kind of some weighted average of the underlying names. And this is actually, it's interesting because the basis is actually kind of there's not many of them, but this is one of the sort of few financial instruments where you can actually have a pure arbitrage trade, right? Where you can basically go and buy index protection and sell single name protection, and you will basically have a arbitrage trade. Because if there's a credit event in the single name and that gets out of your sort of single name portfolio, but the same loss is experienced on your index portfolio as well. So there's actually very few, if any, products out there where you actually have a proper arbitrage, not some statistical arbitrage, not some probability weighted, or not bond basis versus CDS, but you've got a pure arbitrage over here. Which is interesting, I think, at least. But basically, the reason why you get arbitrages is because you've basically got two instruments that kind of trade, right? But they trade independently. So the index trades independently, and the single names trade independently. And when you have two things that basically trade independently, but are actually kind of joined together, is when you kind of get proper arbitrage opportunities. So that's an interesting thing over here. And we have funds who basically set themselves up in order to take advantage of that basis to try and monetize that sort of arbitrage. So you tend not to do it when the basis is 1 or 2 basis points, because your kind of transaction fees kind of eat into the P&L. But you do get opportunities. I think we've got a chart in a little bit. But you do get times where the basis moves around quite a lot. And if you can kind of time it, if you can get in there at the right point, if you've got kind of access to liquidity, you can kind of put on trades where you're able to pick up, 10, 15, basis points of arbitrage free pricing. So how do we actually calculate the value of that arbitrage? Like, how do we actually get to the value of what is like the fair price for the index? Okay, so as I mentioned before, when you think about it, it's probably some kind of like weighted average. But what exactly do we mean by that? So how would we actually go about calculating the spread on a theoretical index? So the first thing we're basically going to say is kind of, what is the cost of buying protection on 125 single name CDS contracts? Okay, so the cost of buying protection is basically going to be, the upfront of the index. Okay, and the upfront of the index is basically then going to be equal to some sort of, sum of the individual names that we buy protection on. So depending on how we kind of weight them, we're going to basically get, the cost of buying protection on 125 names is basically just the sum of buying protection on all of those 125 names. Now, since in our example over here, we're basically going to be equally weighting everything, what we're basically going to get is that is going to be equal to 1 over n times the sum of ui. So all of these things are basically going to kind of be equally weighted throughout the portfolio. So the other thing that we know is the upfront of any index, the upfront of the index is also going to be equal to the spread of the index minus the coupon multiplied by the risk annuity of that index. Okay? So the upfront is basically, as we saw, like we had any single name CDS, the difference between the spread and the coupon multiplied by the risk annuity of that particular index. So if we then basically rewrite this guy we can then, let's say, rewrite that as that's equal to the sum of SI minus coupon times risky annuity I times 1 over n. So essentially, the upfront in this contract is going to be the spread of the index minus the coupon of the index times by the risk annuity. But because they're sort of equally weighted, essentially what we've got is we've got S minus C times risk annuity, i.e. the upfront of each individual name. So basically just this thing over here is equal to that over there. So we're going to then sort of sum up over all of the individual names themselves. The next thing we're going to say is that this risky annuity here, risky annuity I, because everything is kind of equally weighted, is just going to be the sum of the individual risky annuities in an equal weighted form. Okay, so again, the risk annuity of the index itself is basically just kind of the equal weighted sum of all of the single name risky annuities themselves. So what can we then do? Well, we've got kind of we've got our equation here, and we've got our RIs over there. So basically, we're going to say the index spread minus the coupon multiplied by 1 over n times the sum of each of the individual risky annuities is going to be equal to 1 over n times the sum of Si minus C times risky annuity I. Okay? And actually, let's rewrite that one. We good there. Let's do it like sum of S times sum of C times risky, So all we've basically done is kind of expanded out our brackets over there, and we've got S minus C times the sum of our risky annuities, which we took from there, is equal to 1 over n, and expanded that out over there. The next thing you can basically then see is this little bit over here cancels with the C over there. So if we kind of expanded those out, that's what we would be getting. And then we can say with a little bit of rearranging of that equation at the bottom over there, we can basically say that the spread on the index is equal to the two ends are going to cancel with each other, so we're basically going to get the sum of each of the individual single names times the risky annuity of each of the single names divided by the risky annuity of the, well, why don't we do that? I'll say divided by the sum of the risky annuities themselves. And if we go back to our kind of identity that we said we have over there, we can then just replace this with the risky annuity of the index itself. So essentially what we've kind of come to, which we show over here as well, is that essentially your index spread is a weighted sum of each of the individual spreads themselves. And what is the weighting itself? The weighting is basically the risky annuity of that name relative to the risky annuity of the total index itself. Okay? So it's not quite an equally weighted sum, but it is a sum that's effectively weighted by the risky annuity of each individual name. Okay? So what does that kind of practically mean, if you want to kind of think about it, is that as we've kind of seen before, as your spread rises, your risky annuity goes down because the probability of receiving future cash flows starts to decrease, right? So spreads up, risky annuity down. So that basically means that the higher spread names in the portfolio are effectively being weighted by less, right? So as spreads start to go up, you actually start to give kind of less weight to those individual names in the underlying portfolio. So it's not quite, as I said, it's not an equal weighted sum. If you did an equal weighted sum, you would come out probably with a number that kind of gave too much weight to some of the higher spread names. Actually what you're doing is kind of weighting each name by its risky annuity. So effectively what we're kind of saying, as we said at the beginning, is that rather than doing it in spread terms, we kind of take it back to sort of upfront terms, and the upfront of the index is then just an equal weighted of the upfronts of the single names. The upfront of the single name is basically just this kind of guy over here, if we kind of ignore that coupon itself. So I'll let you kind of, you can sort of play through that itself. We spoke about the basis, and that's kind of gone up and down. That's kind of your arbitrage opportunity. The big basis kind of differential was back in 2009. So as you can see for iTraxx main, although the index itself got to 200 basis points as the headline spread, the basis, which was where the kind of theoretical level of the single names got to, was actually 250 basis points. So because the single names are actually trading a lot wider than the index, because the basis, when we talk about the basis, we talk about the traded index level minus the theoretical level. So that at that point, you had a very negative basis, i.e. the single names were trading quite significantly wider. And essentially that was kind of because people at that point, in the early part of the sort of 08-09 crisis, people kind of have a mixture of single name hedges, they go for index hedges, they're kind of going for macro kind of stuff. But then as you start to get through into the crisis, people start to get much more worried, not about like the macro environment only, but actually about kind of single name defaults. So people would kind of buy protection on single names to a much greater extent, and that kind of pushed out or the single name spreads relative to where the index was trading, and you got a very negative basis there. Again, excuse me, back in kind of 2015, again, when people, as I mentioned, were kind of worried about, US slowdown, China slowdown, default cycle, commodities, etc., you started to get quite a negative basis as well, as the single names themselves started to sort of underperform the index. So the basis does give you a bit of a sense as well of kind of like how the market is kind of viewing single name risk, i.e. idiosyncratic risk, relative to index risk, which is reflected by the index itself. There is a bunch of kind of additional material if you want to look at it, and the index rules and composition are available from market itself. Any questions on indices before we switch on to options? Anyone? Crystal clear? Super. So CDX options are next. So indices are the most liquid product that we trade in the credit market. 100 billion roughly on a daily basis. The options are probably kind of the second most liquid product that we trade. And the options that we trade over here are not options on single names, but they're options on the indices themselves. So we do sometimes, or we have in the past, kind of traded options on single names, but we tend to actually trade options on indices themselves much more liquidly. iTraxx main, crossover, senior fins in Europe, high yield and IG in the US, and then also recently, over the last couple of years or so, we started to trade some options on the iTraxx Asia ex Japan. Basically, if we've got like a liquid underlying CDS index, then we tend to have options traded on those indices as well. Most of the options tend to be 5-year expiry, so the underlying is 5 years, but the expiry of the option is basically up to kind of 9 months typically. We don't tend to do options much longer than 9 months in tenor, but the underlying index itself can either be the 5-year or in some cases the 10-year index. They tend to expire on the third Wednesday of each month. So if you want to know when the next option is expiring in May, you go to your calendar, you look where Wednesday is, you say 1, 2, 3, the 18th of May, sorry, that's April, pardon me, May, so 1, 2, 3 gets you to the 16th of May, and that will basically be the option expiry. When we go into June, the option expiry is going to be the third Wednesday again. So you go 1, 2, 3, and you get to kind of the 20th of June. We used to trade the options expiring on the 20th of each month, but it was felt that particularly around sort of the roll dates, there was a lot of option expiry activity, which was kind of influencing the index activity itself. So it was kind of like too much going on one day. So we basically moved to this kind of Thursday, Wednesday of each month. It sounds a bit random, but everyone's kind of got used to it over the years. The options themselves are European-style options. So what does that mean? That basically means that you can exercise the option only on the expiry date. So only on the 16th of May can you exercise that option, but it still has a value prior to the exercise. So it has value prior to the exercise, and that's kind of what you trade in the market. So you can buy and sell prior to expiry, but the expiry is on that date, and you basically get this kind of like, in Europe, sort of 7-hour window between sort of 9 and 4 p.m. to actually exercise the option. It does introduce some sort of interesting things about, what is the value of an option that expires that day if you buy an option in the morning for expiration during the day, what is the value of that particular option? Something I'll leave you with to think about. But also in the US, they also have a sort of similar window, but it's actually European 9 to 4. So in the US, it's basically sort of 9 until 11 US time is when they get to kind of exercise their options. And as I mentioned before, they can kind of be unwound or offset prior to expiration of the options. The options we have, I'm sure we are familiar with kind of equity options, calls and puts. We tend to call them payers and receivers. Okay, so a payer is the right to pay protection. A receiver is the right to receive protection. Okay, so you're either going to be paying protection, i.e. pay spread, or you're going to be receiving protection, i.e. receiving spread. Okay, so a payer option is a short risk trade, a receiver option is a long risk trade. So if we take an example over here, you have I should say two things. The option premiums are upfront amount, so even though the option is an option on the spread, so you would buy protection, let's say the index is at 50 at the moment, you would buy protection, a payer option if spreads go above 60 basis points. The actual cost that you pay is in cents. So we're going to have to look at how to kind of convert from spreads, as in running spreads, into prices, because that's how we kind of price the options. And the interesting thing about these options as well is that they're physically settled options. Okay, they're not cash settled, so you actually physically get into an iTraxx position on the date of expiry if you exercise that option. So you exercise into a physical iTraxx contract, which you can then go and kind of sell in the market if you so choose to do so. So if we take an example, iTraxx main payer option, ignore the kind of dates, but let's say it's expiring in June of this year. Strike is 120 basis points, it's on 100 million notional, and the cost of that option is 16.2 cents. Okay, so in order to buy protection, it's going to cost you 16.2 cents of notional. So what is the cost if you're doing a 100 million trade? 16.2 cents as an upfront amount basically gets you to 162k. So you will pay 162,000 today in order to buy protection for a June expiry option at a strike of 120 basis points. If on the 21st of June the index is trading at 130 basis points, you exercise your option, so you have the right to buy protection at 120, even though the market is at 130. That's the right that you've bought, that's the option that you've bought. So you basically pay an upfront amount based on entering the index at 120, and then you can kind of go and unwind the option in the market at 130. So if the index spread had been below 120 basis points, you wouldn't bother to exercise that option. It would just expire worthless. As long as the index spread itself is above 120 basis points, you would still kind of exercise that option. And in fact, even if the index spread was below 120 basis points, you might still exercise the option because it might be a good way to kind of gain liquidity. You might feel might not be able to get the size of your option, or you don't want to kind of pay bid-ask spread or whatever it might be. But because you physically exercise, you actually get into a physical contract at that level, and that's the option that you have yourself. So this is kind of a typical run that we get from the traders. Receivers on the left-hand side, payers on the right-hand side. The K is the strike. So that basically is the level that you're either going to be receiving protection or paying protection. You can see the prices, the bid-ask over there in the next column. Kind of 2 to 3 cents bid-ask for most of these options. The implied vol, as we will kind of have a look at a little bit later on. And then again, the sort of, we'll look at it again, the break-even. So the break-even is kind of telling you on a daily basis, how much do I need my underlying prices to move in order to kind of break even from these trades. It's sort of another way of looking at sort of the implied volatility of the options. Other things on that, so at the top you can see kind of the index, iTraxx main, you can see the series, you can see the expiry date, you can see the forward, and you can see the current spread, which is what we call kind of the delta or the spot. And again, we'll kind of talk through those as we go through this. So payers and receivers. Okay, if you are buying protection, you are buying a payer. If you are selling protection, you are buying a receiver. So your typical hockey stick diagrams that I'm sure you've kind of seen before from equities. The only thing to kind of get your head around, which takes a little bit of time, is that when you talk about a call option in the equity world, you're kind of talking about prices going up, right? But when spreads go up in our world, that's essentially a sort of short protection, a long protection position. I.e. spreads going up are bad for people who have sold protection, who are long risk. So the hockey stick diagrams that we have, because they're spread based, kind of flip around. So receivers are kind of like the long risk call type of trades, but they go with spreads tighter, and payers, which are kind of the short risk buy protection type of trades, go with spreads going wider. So if you are kind of used to equities, you just have to kind of flip yourself around a little bit. Receivers receive spread, you benefit if spreads go lower. Payers pay spreads, you benefit if spreads go higher. What are the long risk trades then? Long risk trades are either buying receivers, buying the option, or selling the payer. If you sell the payer, you're also putting on a long risk trade. As long as spreads stay where they are or go wider, you're basically going to make money. If you want a bearish trade, then you're basically looking at either selling receivers or buying payers. In both cases, if spreads move wider, you're basically going to be making money in that case. So how do you express this kind of bullish view? You can either sell protection on the index. Okay, that's kind of like the simplest form is just sell main protection, receive the spread, whatever it is, and away you go. However, if you want to kind of like nuance your trade a little bit, you can use an option. So if you buy a receiver, you're basically going to be paid if spreads go tighter than the strike. So it's a long risk trade as well. On the other hand, if you are selling a payer, as you can see over there, you're also going to kind of benefit if spreads tighten, and the amount that you benefit is basically the cost that you sold that option for initially. One thing to also bear in mind is that people talk about options as like risky or levered trades, But the truth is that actually an option trade is a safe trade. Okay, the option trade is basically limiting the downside that you have. Okay, you're basically saying if spreads move wider than a certain strike, I don't want to lose any money. I'm not going to have any exposure, right? So you're basically giving away the downside. Okay, you're not having downside because if it goes above your strike on a receiver, you don't lose any more money, which is kind of where that grey line crosses the blue line in the second chart. But what that means is you kind of have to pay for it. So you're actually going to underperform an outright long position as long as your spread moves tighter. So the option trade itself is actually kind of limiting the downside, which means that it's kind of a less risky trade than selling outright protection itself. Similarly, a bullish trade, you get that selling payer gives you the same thing, and on bearish trades you've kind of got the same thing but kind of flipped around. So bearish trades are buying protection, buying payers, or selling receivers in the market. Again, these kind of different trades give you sort of different upsides and downsides. If you want to think about one way to kind of think about, should I be selling index protection or should I be, let's do it from the short position. So, which one of these three is the right trade for me? Okay, do I want to go and buy protection? Do I want to go and buy a payer option, or do I want to go and sell a receiver option? Okay. Now, one thing, as you may know, or we will see in a second. So, if we, draw our payoff diagram. So let's say that's spreads going higher. So let's say this is, 100 basis points, and this is like 150 basis points. If we buy index protection, at 100 basis points, we're basically going to kind of, make money. Let's say that's our P&L. As spreads go wider, we sort of make money. As spreads go tighter, we're going to have, losing money. This is kind of, zero P&L, let's say. Okay. Now, if we wanted to do the same trade in the index space, let's say we wanted to buy a payer. Okay. Now, an at-the-money payer, the delta of an at-the-money payer is 50%. Okay, we'll look at that in a second. But what that basically means is that the kind of index equivalent exposure is 50% of the index. So if you bought 100 million of options, you would effectively have 50 million of index exposure. It kind of gives you the same P&L. So in order to increase the amount of exposure that you have such that it's the same as the index, you would buy kind of 2 times the notional. Okay, so 100 million of index would be equivalent to buying 200 million of option. Okay, so if you bought 200 million of option, it's basically going to look something like that, and then at the strike, it starts to kind of appreciate, but with sort of 2 times the velocity. Right? Because you've got twice the notional, so you're going to kind of lose money, but you're going to kind of make a lot more money if spreads go wider. So that's if you've got like equal delta, so you've bought 2 times the number of options. On the other hand, if you sold protection, you're going to have something that kind of looks, let's say, like, you're going to sell protection over there, so you're going to make money there, and then you're going to kind of, lose money as you go down that way. Okay? So what is like the difference between these kind of different trades? They've all got the same delta, right? So they've all got like 100% delta, 100 million of index exposure. If you're buying, I probably should have done it in different colors, but if you're buying, if you're buying this one here, which is the payer option, when do you outperform the blue one? You outperform either when spreads go a lot tighter or when spreads go a lot wider. Okay? So if you think spreads are either going to go a lot tighter or a lot wider, what should you do? Buy a payer option or buy index protection? You should buy the payer option. Okay? Because if spreads go a lot wider, you're going to make more money, and if spreads go a lot tighter, you're going to lose less money. Right? Whereas on the other hand, if you think that actually spreads are not kind of moving either way very much, then you should go for selling the payer. Selling the payer over there. Selling the receiver, pardon me. Selling the receiver trade. So why over there? Because over here, you've sold the receiver. If spreads go a lot wider, okay, you don't make as much as the index trade. And if spreads go a lot tighter, then you kind of lose more than the index trade. But basically in this region over here, you know, as opposed to this region over there, yeah, in this region over here, you're actually kind of making more money from the option trade. Okay? The option, which is the green line, outperforms the blue line as long as spreads stay between these 2 points over here. So what does that kind of mean? As long as spreads stay in a range, you're going to outperform from selling the payer, selling the receiver option relative, or selling 2 times the receiver option relative to the index. So again, it's kind of gives you a sense, like if spreads are moving a lot, you want to buy payers. If spreads are moving a little bit, you want to sell receivers. Okay? So when do spreads move a lot? When there's a lot of volatility. When do spreads move a little bit? When there's not a lot of volatility. And again, we'll kind of look at it a little bit later, but just to give you a kind of a sense of like, well, you know, when should I be buying payers? When should I be buying receivers? When should I be doing index trades? One way to kind of think about it is to think, you know, when do I outperform for a sort of equal delta type of trade? So, some of the kind of questions that we're going to be looking at for options. Firstly, you know, what's the cost of the option? Like, how much do I pay to buy the option? When will I exercise the option, or what does like the payoff look like when I exercise that option? What spreads do I need to break even? Because remember, with the option, if I'm buying an option, I've kind of paid an amount up front. So at what point do I make enough money from spread widening to kind of compensate me for the upfront amount that I've paid? Because even if spreads go past my strike, I might lose money in the overall trade because I basically paid more for the option than I'm going to be receiving. And then finally, you know, what happens if a name in the underlying portfolio defaults? If we have a default in one of those names, how does that actually kind of play out in the option itself? So let's, again, you know, take an example over here. June 2016, you know, don't worry about the date expiry, a strike of 500 basis points on 100 million of notional. The cost of the option is 150 cents. So remember, cents and basis points are kind of the same unit, but cents are upfront and basis points tend to be kind of running. So when we talk about like a running spread, i.e. an annual spread, it's in kind of basis points. When we talk about like an upfront cost, it's going to be in sort of a cents number. So you pay 150 cents upfront. Your current spread is 420. And you are buying a payer option, so you've basically got the right to buy protection at 500 basis points if spreads, you know, go above 500 basis points. So what's your initial cost? Very simply, 150 cents times the notional. 150 cents is 1.5%. 1.5% of 100 million notional is basically going to give you 1.5 million in terms of cost. So the cost of this option is 1.5 million on 100 million notional of trade. So that's the first kind of thing to bear in mind. The next question you ask yourself is, okay, so I've paid 1.5 million in terms of like entering this option, but at what point do I make enough money from the option in order to compensate me for the cost of buying that option in the first place? Right? So that's basically what we would call our break-even in the trade. So the break-even basically means how much, you know, where do I need spreads to go above the strike? The strike in this case is 500 basis points. Where do I need spreads to go above the strike in order to sort of break even from this trade, in order to have a sort of a zero P&L? So the way to kind of think about that is that, you know, when we have our when we have our payoff over here, basically each basis point that we make over here, so each additional basis point that spreads go up by, the P&L that we're going to be making is basically going to be 1 basis point times by whatever the duration of the index is at that point in time. Okay, so if spreads go to, this is 500, if they go to 501, we're going to make 1 basis point times the forward duration. So if the forward duration is like 3.5, we're going to make 3.5 cents at 501. 502, we're going to make 2 basis points times a duration of 3.5. So how much do we need spreads to widen until we basically get to here? Well, because of the kind of symmetry that we've got over there, we basically just take the cost of the option. So we're basically going to get our break even is equal to the cost of the option divided by the forward duration. Okay? i.e., how much do we need spreads to widen above here in order to break even, plus whatever the strike of our option is going to be. Okay, so the strike plus the cost divided by the forward duration is basically going to give us the break even of the trade. So in this case, let's assume that our forward duration is 3.5. We've got a strike of 500. We paid 150 cents. So 150 cents divided by 3.5 gives us 43. So basically, we will break even at 543 basis points. So as long as spreads go above that level, we will make money in this trade. Okay? If we sold the payer option, as long as spreads stayed below 543 basis points, similarly, we would make money. On the other hand, if we bought a receiver, then you have to kind of flip everything around. If we bought a receiver for 150 cents, then your break even is going to be 43 basis points tighter than 500 because you kind of need to make money. You know, you need to make that same amount, but you're going to be making it on this side of 500 rather than on the other side. So the break even is basically, you know, pretty straightforward. What is your strike? Plus what is the cost of the option divided by the forward duration, because that basically tells us how high we need spreads to go in order to kind of break even, in order like to have a zero P&L to make back just the cost of the entry of that particular option. And then I guess the final thing that we then look at is what is kind of the P&L of our trade. So if we assume that spreads, let's say in this case, go to 600 basis points, okay, what's the P&L? So the P&L is basically going to be 600 basis points minus our strike, so 100 basis points multiplied by the forward duration, multiplied by the notional, minus the cost that we initially paid out. So it's going to be 100 basis points times forward duration of 3.5 in this case, times 100 million notional, which is basically going to give us 3.5% times our notional minus the 1.5% that we paid up front in order to enter that trade. So net, if spreads go to 600 basis points, let's say that's kind of somewhere over here, we're going to make 2 million from our particular trade. So the kind of key things to remember, what is the upfront in your option? It's the cost of the option in cents multiplied by the notional. What is your break even? Your break even is the strike plus or minus, depending on whether you're buying a payer or buying a receiver, or selling a payer or selling a receiver, the initial cost divided by the forward duration. And what is the P&L that you might make? Basically, the difference between where spreads eventually are on expiry minus the strike times duration times the notional minus the initial cost of your option. So again, if you're kind of used to seeing like equities, it's a little bit more involved than equities because you have to kind of use your duration. So you take your difference in spread times duration as your P&L, but otherwise, and you kind of have to flip things around if you're used to kind of looking at calls and puts, but otherwise it's pretty much sort of exactly the same as you would see in any other option space itself. That's probably a good time to break. Why don't we have a break for 15 minutes? And we can kick off again at 7:40. Hello.
Sorry, I want to ask why do we need to multiply the duration here? What is it?
Because we need to get it into a like P&L cents amount. So 1 basis point, because this is a contract that is going to be 1 basis point per year for 5 years. So it's not just 1 times 1 basis point.
So,
It's 1 basis point times the duration.
so that means the contract.
It's a 5-year contract.
So why is 3.5?
Because that's what we're saying is the forward duration of the contract. So at expiry, what is the duration of that contract? Okay, shall we continue? All right, so going on with CDS options. So CDS options have another. So other than kind of before I go on, mate, there was a question I had about why there is when you're calculating your P&L over here, why do you have to multiply it by the duration? So just as a reminder, when we're talking about P&L, we're talking in upfront amounts, okay? When we're talking about spreads, we're talking about sort of running annual amounts, i.e. you have the right to buy protection where you're going to pay 500 basis points per year for the next 5 years. The index itself is at 600 basis points, which means that if you were to buy protection at that point in time, you would have to pay 600 basis points per year for the next 5 years. That is a running basis point amount. However, when we're talking about P&L, we're talking about what is our profit and loss today. So in order to calculate that, you basically have to take that difference between 600 and 500 and put it into a present value term. How do you put that into a present value term? You multiply it by either your forward annuity or your forward duration, if we're sort of simplifying things. So that 3.5 is basically to get 100 basis points per year into a cash upfront amount today. So the forward annuity or forward duration is kind of what we're using over there to see or to convert between running spreads, which talk about per year every year, into a kind of P&L, which is actually an upfront amount, as we've sort of seen before. So what is some of the other kind of another interesting feature of index options? So if you had a name, let's say you have an option to buy protection on a single name CDS contract, okay? So you want to buy protection at 500 basis points. Okay? Let's imagine, and that's for, until June. Okay? Let's imagine that before the contract expires, there's a credit event in the underlying name. Okay? So the name defaults, you have a credit event, and then your option expires subsequently. Okay? You don't actually have a CDS to get into at that point in time because the option has, or the CDS has defaulted, the contract has finished, and then you don't actually have a spread at which you can kind of buy CDS protection. Okay? So actually when you're kind of talking about sort of single name CDS, they tend to actually sort of knock out on default. So if you have a credit event, it disappears, which kind of sounds like, not something that's necessarily desirable, but the indices on the other hand are what we call no knockout. Okay? So the indices, that basically means that when you buy protection today for a June expiry, if there are any credit events between today and June, you actually get the benefit of that in your protection position. So in your payer, you're basically going to get the benefit of that default that happens. So that's all. So CDS options, although they're kind of options on the forward, I want to buy protection in 3 months' time, starting on the 20th of June for the iTraxx index that's kind of in the market at that point in time. You actually get protection starting today because they have this no knockout feature. So how do we kind of think about that no knockout feature? Well, imagine you had you have an index that has a credit event in a few weeks' time. What is the P&L from that credit event? Well, that kind of break even, which is this kind of break even spread that we talk about there, is basically going to be what is your P&L from that default. So let's assume, let's kind of talk about it simplistically. Let's say you have 100 names in the portfolio. Each name is therefore worth 1%. Let's assume that the recovery on the CDS is 50%. So effectively you're going to make 50% of 1% in your P&L. So you're basically going to make 0.5% in P&L. Okay? If you exercise the option, you will basically make 0.5%. So what does that mean? That actually means, if you think about it, that you will exercise the option to go into a long protection position even if spreads are less than 500 basis points. So even though your strike is at 500 basis points, you will actually exercise protection if your index is at, let's say, 495. Okay? Because you'll get into an index position at 500, which you can sort of sell at 495, but you've actually made money because you're going to get the benefit of that single name that has defaulted. So you're basically going to make 0.5%, which if you divide by your duration is going to give you 10 basis points. So as long as spreads are kind of 10 basis points tighter than your strike, you would still exercise your protection position. Okay? So it might take a little bit of time for that to sort of sink in, but when you buy protection, unlike in a equity index that you might be kind of used to, if you're above the strike, you exercise. If you're below the strike, you don't bother. In the credit world, you might actually exercise your option even if you're below the strike, because you're going to get the benefit of the default that's happened between when you bought the option and when the expiry of the option is. And that's kind of like an additional benefit that's given to you. So the option basically gives you not just protection starting from the expiry of the option, not just from June, it actually gives you protection starting from today. Okay? So you are protected against defaults in the underlying index starting from today up until the expiry of the option, and then you get into the index position itself. So that sounds very nice. And that's great. You're a buyer of protection. Not only do you get the spread widening, but you also get any defaults in the index as well. On the other hand, if you're selling that payer option, you're going to say, well, hang on a second, you need to pay me, okay? I'm happy to sell you a 500 strike basis point option, and you can have the benefit of any defaults from today until the expiry of the option, but you're going to actually have to pay me to buy that option. So there's like an additional cost for that option. Okay? You need to basically pay the cost of protection from today until you enter into that option itself. So how do we kind of deal with this in the CDS world? Well, the way that we basically kind of deal with it is we make an adjustment to the forward. Okay? So as you saw, I think with Moritz last time, the forward that we can calculate is just the difference between the kind of longer CDS and the shorter CDS. So when we're buying an option, we're buying the right to buy protection from June for the maturity of the index itself. So we basically got a forward trade on there. Okay, so we're entering into a forward. We're buying a forward starting protection position today. But we get the benefit of an additional amount of default. So how do we kind of deal with that? Well, we have this kind of what we call the no knockout adjustment. Okay, and the no knockout adjustment is basically an amount that we add onto the forward such that the forward itself is actually higher than our sort of calculated forward would otherwise be. Okay, so the forward is higher, which then makes the payer options look more expensive, because actually if you have an at the money option, so if you have something that's like at the strike, which is at the index level today, i.e. like, the index is at 500 basis points and the strike is at 500 basis points, actually that option is already in the money, because the forward that we're using is going to be higher than 500 basis points. So how do we kind of calculate that forward annuity? So we basically, as we've seen over here, so we've got over here, we've got the spread. So normally if we were going to calculate a forward, we'd basically do like, the spread on the longer CDS contract times the annuity of the longer one minus the spread on the shorter one times the annuity of the shorter one, divided by the difference in annuity between those two. Okay? But here, as we said before, we're going to kind of add on some amount of protection, because that's kind of reflective of the cost of protection to expiry. So how is that going to be? That's going to be spread times the shorter maturity times the shorter maturity risky annuity, divided by the risky annuity times risky annuity T minus the risky annuity of the sort of shorter one. Okay, that's basically going to be this is the adjustment that we make to our forward. All right. So what can we now do? Well, we can now basically cancel this bit with this bit. Okay, and we're basically going to be left with is equal the longer spread times the annuity divided by the risky annuity to T minus the risky annuity to our sort of shorter 3-month option expiry, whatever that's going to be. We can then basically kind of do a little bit of sort of rearranging. So if we add on to this top bit, if we just multiply, if we add, let's say if we add ST times risky annuity T minus T times risky annuity T. So we're just going to kind of like, add and subtract an amount. We can then basically do a little bit of factoring and say that we're going to get ST divided by, ST times risky annuity T minus risky annuity of the shorter one divided by risky annuity T minus plus risky, plus the shorter spread times risky annuity of the shorter one divided by T minus risky annuity of small t. Okay, so you just do a little bit of kind of factorizing of that over there. We can then see that that bit cancels out with that bit, and we're basically left with something that looks like this. That the forward is equal to the spread on the contract plus the spread to time t multiplied by the risky annuity to time t divided by the risky annuity t minus risky annuity t. Okay, which is effectively what we've kind of done. This is a, should be a big T there. Is that right? Where have I missed my T? Sorry. Yeah. Sorry, we should have been adding that, subtracting that there, and that comes out there, and that comes there. So again, we add on to it, we factorize it, and we basically get spread t times risk annuity t divided by the difference in risk annuity, which is essentially kind of equal to the forward. We can then say is equal to kind of the spread. Okay, so that's kind of like the spread on the contract plus the spread on the contract, which is essentially kind of the contract spread. Sorry, the spread on the contract times this kind of risky annuity t, which is basically kind of like, because it's like 3 months or 1 month. The risky annuity over there is basically going to be just like the time to expiry. Okay, so that's going to be equal to effectively like the carry of the contract. Okay, so the index spread times by, it's meant to be the risky annuity for 3 months, but we'll just say that's kind of equal to, like 3 months of time, because you have very short time periods, so you don't have much kind of risk in there effectively, and your interest rate exposure is quite low. So we can kind of approximate that by just the sort of time to expiry divided by this bit over here, which is basically the difference in risky annuity. So again, we'll kind of say that this is quite small, so we won't worry about that too much, and we'll basically say it's equal to kind of the forward risky annuity effectively. So basically, we can effectively kind of say once we do, we get to this sort of here, and then what that kind of means sort of intuitively is that it's equal to sort of the spread plus the carry. The carry is equal to the spread times the time to maturity divided by the forward risky annuity of that contract. So what does that kind of mean? Is if you think about it sort of intuitively, what are we kind of saying? We're saying, well, if we've got a contract that lasts for 3 months, the cost of protection for 3 months is the 3-month carry. Like, how much do we have to pay? Okay, that is effectively the cost of buying 3-month protection, but we need that in a basis point amount, so we kind of divide that by the forward risky annuity of the contract, and then we add that onto the index spread itself, and that gives us whatever the forward of the contract is basically going to be. So the forward is always kind of higher, or this sort of adjusted forward that we use for CDS purposes is basically always going to be higher than the spot, the longer the time to expiry, the higher that forward is going to be. So when you see kind of forwards, as we kind of looked at back early on in the presentation, when you look at the forward from the runs, you can see that the index itself is at 75, but the forward is kind of like 5 or 6 basis points higher than that, and that basically comes about because of this no knockout option and this additional value of the carry that we're getting from the CDS option itself. So how do we value CDS options? CDS option is kind of like any other option that you've seen. The current spread level is going to be important. The strike of the option is going to matter. The expiry of the option is going to matter. The volatility of the option is going to matter, and the rates that you kind of put in there when you're doing your discounting is going to matter as well. Of all of these things, spreads are determined by the market because that's kind of where things are trading at the moment. The strike and expiry are chosen by the investor who's buying or selling that particular option. The rates exposure is quite small because you have a kind of CDS spread discounting over there. So actually the main exposure that you kind of have is your volatility. Okay? So volatility goes into the pricing of the CDS options. If volatility is higher, then the option is going to be worth more. So as a simple example, if you take a CDS contract with a spread of 100 basis points, if you have one CDS contract that has a volatility where it moves up and down by 1 basis point each day, and you have another CDS contract where the spread is moving up and down by 10 basis points each day, which option is going to be more expensive? The one that has the higher volatility is going to be the one that's more expensive, i.e. the one that moves up and down by 10 basis points each day is going to cost you a lot more. Why is that? Because as we saw earlier, when you buy an option, you're basically doing a safer trade, i.e. if spreads move much tighter, you're not going to lose much money, and if spreads move much wider, you're actually going to make a bit more if you're kind of doing it in a delta neutral amount. So volatility is kind of like the key thing, as you would find with options, that determines how valuable they are. The more volatility you have, the more valuable the option, therefore the higher cost that option is going to be. So when we kind of look at these options, we kind of look at the implied volatility, and the implied volatility that we have is quoted on an annual spread basis. Okay? So when you look at a CDS option, the volatility will be kind of percentage volatility based on the spread. So 60% basically means a annual spread volatility of 60%. Now, if you go to someone and you say, what's the vol of the FTSE 100? And someone says, well, it's kind of like 15%. You can kind of get a bit of like an intuitive understanding of what that means, right? It means that kind of over a year, one standard deviation is going to be like 15% either way of whatever the current level is. Okay? You can kind of get a bit of a sense of what that means. In credit, it's a bit more kind of difficult because you're kind of talking about like 60%, and that's like 60% of spread. But normally we kind of think in like basis point amounts. So how do we kind of convert from spread amounts to or percentage amounts to basis point amounts? We basically use our equation that we've got over there, where we basically say that, and this is quite a kind of a useful sort of metric to have, is to say that the daily vol, okay, is going to be equal to the annual vol. So that's kind of the number that is sort of going into our model and kind of quoted, and that's in a kind of percentage term, and let's say this is in basis points. Okay, so we've got annual vol. Now we want to get annual vol into daily volatility. So we multiply that by 1 over the square root of time, because that's how we basically convert. If we have volatility annualized, if we want to get daily volatility, we basically multiply by 1 over square root of 200 and let's call it 260, if that's the number of days in a year. So that basically then gives us daily percentage volatility. And if we now want to see how that is on a basis point amount, we then basically have to multiply that by our forward level itself. Okay, so daily basis point volatility is basically equal to annual volatility moved onto a daily basis by dividing by the square root of the number of days in a year, multiplied by our forward level, which gives us a volatility. So if we have an I vol, as we've seen over here, implied vol of 50%, if the forward is at 100 basis points, we can basically see that that kind of implies a 3.1 basis point per day move. And that's something that's a bit more kind of like intuitive for people to understand. So you can basically kind of take your annual vol and convert it into a kind of a day-to-day move, and gives you a sort of sense of like, is this option worth buying or not, based on kind of like an intuitive feel, because we kind of know how things move on a day-to-day basis. So when we have an implied vol number and we can get that onto a sort of basis point day-to-day measure, that's quite useful to have. When we look at it versus realized volatility, so that's kind of like our implied volatility number over there. Realized volatility is basically just kind of calculated as the log difference of spreads on each day. Again, we're multiplying over here, as you can see, by 252, 252, 260, whatever it is. That's basically kind of the number of days in a year. So if we take our sort of daily change in spread, calculate the difference between that, the difference of those kind of log changes, because our kind of daily average change is going to be 0. We just look at the sort of log differential squared over there, multiplied by the square root of 252, gives us our kind of realized volatility number. So we've got our implied volatility, which is sort of the thing that we plug into the option to price it, or the thing that kind of comes out of the option when we put in prices, and then we've got our kind of realized volatility on the other side. We won't go into this in kind of too much detail, but if you are kind of interested in sort of looking at CDS options a little bit more, we've spoken about sort of this forward that we use, how to kind of calculate the forward. We have to have a no knockout option, so we kind of take that sort of carry, we take the price of protection, we add it onto the forward. The other thing that you kind of need to realize is when you're pricing CDS options is that, remember, when we trade an index, we are actually trading an upfront, because the index has a fixed coupon. Okay, so the option itself is actually an option on an upfront amount, not an option on the spread. Okay, we kind of quote it in spread terms and we talk about it in spread terms, but actually when we sort of exercise that option, we pay an upfront to get into the contract, and we then can kind of sell the option, sell the index and receive an upfront when we get out of that contract. So the kind of P&L on our option is not quite like the change in spread times duration, which is kind of what we were approximating it by before, but it's basically the difference in the upfront based on the spread and the different versus where the upfront is based on where the market, where the strike of our option is versus where the market spread is itself. So the cost of the option is basically a weighted probability discounted back to today, and you can kind of use your standard black model on that in order to sort of find what the price of that option is at any point in time. Again, we're not going to, it's a bit sort of too much for our purposes of here, but essentially if you do want to look at it in a bit more detail, it is sort of the interesting things about credit options is number one, that's this kind of like adjustment that you make for the price of protection, and number two, you've got this, what we would call a sort of convexity adjustment, because the index allows you to kind of get into it at a fixed price, so it's really an upfront that you're paying, and then you're getting out of it at a fixed spread or a fixed upfront as well. But that basically allows us to then kind of do things like pricing the option prior to expiry. So we've looked at the price of this option at expiry, which is our standard hockey stick diagrams, but we can also kind of value the option anytime prior to expiry. Okay, so we have a model, it has a price that comes out of it, or we have a market that basically prices stuff, and that price of the option is basically kind of something that's traded in the market. We also, as you have with all other options, have the Greeks. So effectively, sorry, that skipped through. So we have the delta of the option. So the delta in the option is essentially the sensitivity of the option. Okay. If the index moves by 1 basis point, what is the P&L in my option itself? Okay, how much money do I make or lose from a 1 basis point change in the underlying index itself? The gamma is the change in that delta. So how does my delta change as I go through changes in spread itself? The theta is the time value of that option. The vega is the sensitivity of the option to prices, and the rho is essentially the change in the option with respect to interest rates. So, delta. Delta is kind of like the first order approximation of the changes in the price of the option relative to the changes in the underlying index. So, one way to kind of look at an option is essentially if you kind of imagine that you've bought what we would kind of call like a binary option. Okay, so effectively you sort of bought protection at what's this one? You've bought protection at like 100 basis points, and then you've sold protection. So let me rephrase it. You've bought a payer option at 100 basis points, and then you've sold a payer option at 101 basis points. Okay, so as spreads go from 100 to 101 basis points, you're basically going to make a P&L. Okay, that P&L that you make is 1 basis point times the duration of the contract. So in this case, our forward duration is 4.5. So if we go from 100 to 101 basis points, we basically make 4.5 cents, essentially. Okay? Now the question is, what is like and let's assume that that's like the at the money type of level. So the question is, like, what is the cost of that option? Okay? And the cost of that option today is basically what the delta of the option is as well. So how much does it cost me today to basically enter into an option such that if I go above this strike, I'm basically going to make 4.5 cents. Right? So it's effectively saying, like, what is my probability to some extent of being above that strike? Because the probability that I'm above it means I'm going to make 4.5 cents, and the probability that I'm below it means I'm going to make nothing. So the delta can also be sort of thought of as the probability of landing up in the money for a particular option. Okay? So at the money means like at the forward. So your delta of your forward is basically, if you have an option that's struck at the forward, it's like 50-50. You're either going to end up in the money or you're going to end up like out of the money. So the delta of an at the money forward option is basically going to be 50%. As you go higher in strikes, the delta gets closer and closer to 1. You're like guaranteed to land up in the money. Okay? So if you think of your sort of binary option over here, as spreads start to increase, you're like almost certain to be above 100 basis points and sort of stay in the money. So your delta starts to increase at that point. And similarly, as you kind of get lower and lower in spreads, as you see over here, your kind of delta goes back down to 0 again. So the delta ranges between 0 and 1, or 0 and -1, depending on which way you've sort of looked at it. But it basically kind of reflects the probability, or you can sort of think of it as your probability of sort of ending up in the money if you buy an option. So an at the money option, as I said, has a 50%. If you go very low in strike, the chances that you're going to kind of break through and exercise this binary option basically goes to 0. So your probability is 0. Your delta is 0. On the other hand, if spreads are very high, if the spread goes to like 150 basis points, you're almost certainly by expiry going to remain above 100 basis points, so you're basically going to be making more money. And that also kind of gives you a sense of like how your delta might change as you have time. So more time basically means that your delta doesn't change quite as much. And as you get closer and closer to expiry, you're basically only really going to have like a delta changing if you're at the money, if you're kind of close to that point. Because if you've only got 1 day to go and you're sort of well out of the money, your delta's not really going to change very much in terms of the changes in spread. So that kind of second order is effectively your convexity or your gamma. So your gamma talks about how does the delta of the option change as my spread itself changes. So your gamma, as we can see over here, at which point is the change in the delta the most? The change in the delta is the most basically when you're sort of at the money. So an at the money option has sort of the highest gamma, okay? But if you move very low in spreads, very much out of the money, then your delta doesn't really change very much for sort of 1 basis point changes in the underlying spread. So your delta changes very little, which means that your convexity or your gamma is quite low. At the money, you start to increase and you start to get a lot more kind of convexity in that trade. Now remember, if you've bought an option, okay, the convexity sort of works in your favor, right? As you spreads move wider, the convexity means that the delta goes up. So if you have positive convexity, if you have positive gamma, you're actually going to be kind of making more money. It's not just that your delta stays the same, your delta actually increases, i.e. your sensitivity to the underlying spread increases as you go higher and higher. So the kind of more convexity that you can have, the more gamma that you have, the better your trade is going to be. So when you buy an option, you actually have positive convexity, okay? As spreads go up, you kind of like, your delta doesn't just stay the same, your delta actually increases as it goes from sort of 0 to 100, and as spreads go down, you actually kind of lose less. So you're kind of like making more as spreads go wider, because you've bought the option, and you're actually losing less as spreads go down. So that's quite nice. If you've got positive convexity over there, you make more money as spreads go up, you lose less money as spreads go down. But what is the cost of that? Well, the cost of that is what effectively we kind of call the theta. So the theta of the option is basically the time value of that particular option. Okay? So what does that mean? That means that each day that passes, your option becomes less valuable. Right? If I've got a 3-month option today, the possibility, and let's say I'm at the money, okay? So the strike is 100, and I'm at 100, okay? 3 months, I can, and let's say volatility is like 50%, I can go up to 110. Spreads might go to 150 basis points. If you've got a long time, if you're kind of here today, and this reflects your kind of, volatility bound, and let's say you've got an option that's kind of struck over here, so anything above this kind of makes you money. The longer you have in terms of time, the more variability you have, the more opportunity there is to kind of make more money. So the longer an option is, the more kind of value it has in terms of time. However, as you get sort of closer and closer over here, when the option, or let's say you get over here, you're kind of moving through time, your option values are now, only making money if spreads move like that because you've got much less time to expiry. The option basically loses value. Like the chances of you making a lot of money actually kind of decreases quite significantly if you stay at the money. So longer dated options have more value, shorter dated options have less value. The loss in time value is effectively what we call the theta of the option. Now, when you buy an option, you have positive convexity, but you also, as a cost of that, have negative theta. Okay? So effectively what we sort of say is that the cost of having this positively convex position, where you make more money if spreads go up, you lose less money if spreads go down, is basically that each day that passes is effectively the cost of the option, is the lost opportunity, is going to be your sort of theta in that option. I think we'll come back to that we'll come back to another thing about that in a second. And then finally, the vega of the option is your sensitivity to volatility. Again, if we think about the kind of range of possibilities that our option might end up at, if volatility is very low, we're not going to have very many kind of opportunities to make money. Vol is quite low, it doesn't really give us very much. Whereas if volatility increases, then our range of probabilities increase, and effectively the kind of P&L that we can make increases as well. So as we saw earlier, the more volatility there is, the more implied volatility there is, the more vega, the higher the value of their option. Again, as you kind of get shorter and shorter in time, as time passes, your vega starts to decrease. So longer dated options have much higher vega, much higher sensitivity to volatility. Short dated options tend to not have very much sensitivity to volatility. And similarly, an at the money option has kind of the highest sensitivity to volatility because you can either go up or down. If you've got a very much like in the money option, which is something like that, it's kind of almost guaranteed to make you money, then your sensitivity to volatility in that case is actually rather small. So how do we think about sort of delta hedging an option then, if we kind of take all of these things and put them together? Basically, delta hedging an option is effectively buying the option and then doing the opposite position in the underlying index. Okay? So if we bought a payer option, 100 million of payer option, what is the trade that we would do in the underlying index? We would basically go and sell a receiver option against it. Okay? So we buy a So if we buy a payer option, let's do that. So we buy a payer option. It looks like that at expiry. Prior to expiry, it's going to look something like that wasn't great. Prior to expiry, it's going to look something like that. Okay. So that's the payer option, we've bought that. Against that, what do we go and do? We go and say sell a index position, and we sell it in the same notional as we have over there in the option. So what does that kind of end up with if we sort of take those two positions together? We basically get something that looks like that. Right? So we're basically left with what we would call, when you delta hedge an option, you basically get left with a kind of positively convex position. Okay? So if you bought 100 million of payer and you sold 50 million of index protection against it, you'd basically be left with something that looks like that. So that looks pretty nice. Okay? This is your P&L. This is your spread. You basically make money all the time. If spreads go wider, you make money, and if spreads go tighter, you make money. that might seem like a good trade. What is the cost of that? The cost of that is obviously, as we've kind of seen before, is the theta, right? So this is like an instantaneous move, okay? But as one day passes, the option itself actually kind of loses money. So our P&L chart actually starts to look something, let's do it in a different color. Our P&L chart actually starts to look something like that, right? So we actually kind of lose money between these 2 points over here, okay? If spreads are actually, if spreads stay the same, we're actually going to lose money, and how much money are we going to lose? We're actually going to lose the theta of the option. We're going to lose like the daily decay, right? Where do we break even? We basically break even if spreads move by some amount, okay? So as you can see, what this kind of tells us is that we need the index to move on a daily basis by basically more than the theta. So as long as we get an index move in the underlying spread by an amount that's greater than the theta such that we make money, we're basically going to kind of break even from that trade. So the cost, as I said, of having this positive convexity, of having this nice chart that looks like that, is that we have to pay away the theta. So the cost of gamma is basically theta, and that's what when people kind of talk about delta hedging, they're basically doing a kind of trade-off between the gamma of the option and the theta of the option, right? So they're kind of, those two things are sort of like the inverse of each other. The other thing that you can kind of think about as well is what determines the theta of the option, right? Effectively the volatility. So the volatility determines the price of the option, as we saw, the implied volatility, and that basically determines, therefore, what your kind of daily decay is going to be. What determines how much money you're actually going to make? Well, that's actually your kind of realized volatility. Okay? The more realized volatility you have, the more you're going to be on one side or the other of that theta loss. So effectively, again, when you're delta hedging options, you're basically trading the difference between the sort of implied volatility, which gives you that, and the realized volatility, which gives you that over there. So delta hedging, as I said, is kind of a game between realizing more volatility than you're losing in theta versus effectively your kind of implied versus realized volatility. Finally, how does it look if you kind of add Vega into the picture over there? So Vega basically then sort of, as volatility goes up, you actually get a similar type of payoff, but actually you get a kind of higher P&L. So actually you can kind of get an offset from your theta either because the index moves or because the implied volatility goes up. So when you have a sort of a change in volatility, you can also make money in your option. Okay? Now, as we said before, when is your kind of Vega highest? Your Vega is highest for longer dated options. As you get to sort of shorter dated options that look something like this, then your kind of Vega actually gets quite small. The other thing is your delta is actually the highest for sort of short-dated options, or your gamma is the highest for short-dated options. Imagine you've got a one-day option that sort of, so an option that expires tomorrow and you're at the money. If spreads move 1 basis point lower, you're out of the money. Spreads move 1 basis point higher, you're like in the money, right? So your delta is basically changing between 0 and 100, which means that your gamma is exceptionally high at that point. So short-dated options tend to have higher gamma, and they also tend to actually have much higher theta as well. Whereas long-dated options have much less exposure to theta, to gamma and theta. If I've got a 1,000-day option versus a 999-day option, the value in those is going to be very limited. A 1-day option compared to a 2-day option is going to have a much bigger difference over there. So when we're looking at trading Vega, we actually trade long-dated options. And when we're looking at trading theta or gamma, we're talking about kind of trading short-dated options. So how do you kind of combine all of these? When you're like trading this, you kind of have a choice, like, do I want to be long gamma or long theta? If I want to be long gamma, I buy options. If I want to be long theta, I sell options. If I want to be long vega, I buy options, but I need to buy long dated options. And if I want to be short vega, then I sell long dated options. So you can get positions where you can be like long gamma but short vega. How do you do that? If you buy a long dated option, which gives you a long vega position, and sell a short dated option, it's going to give you a short gamma position. So you can actually do kind of combinations of calendar trades to give you sort of differences between sort of gamma and vega type of positions. So historical vols, as we saw before, we kind of, you can price them just in a sort of simple, where was it? A simple log fashion over there. You realize vol is basically your kind of log spread differential. Historically, volatility on the iTraxx indices, as you can kind of see that green line over there, it kind of ranges around about sort of 50%. Like 50% is kind of the average vol, except when we went into the 2007-2008 crisis, you actually got like 3-month vol going all the way up to like 140%. So if you think about equities, you never really get that kind of volatility in the equity space. We recently had like a VIX spike where VIX spiked up to around about like mid-30s. In the credit market, you actually get sort of order of magnitude of those type of volatilities as well. So blue line is implied volatility, which comes out of the model, and the green line is realized volatility. A couple of other things before we kind of finish off. So volatility skew. Excuse me. Volatility skew basically talks about how is like the shape of the volatility surface. So, typically you should expect volatility to be flat, implied volatility to be flat, i.e. it doesn't really matter where spreads are. We're talking about like how volatile they are. Typically they should be, the same everywhere. But actually what we tend to find is that people pay more for out of the money options. So people like to hedge, and therefore they kind of pay more for the high strike options. The high strike options, because they're kind of out of the money, are optically cheaper. But essentially that means that the sort of volatility looks a lot higher than it otherwise is. So we tend to get these kind of like volatility surfaces which have sort of positive skew associated with them. So it's more expensive in volatility terms to buy out of the money payer options, to buy sort of high strike payer options. An interesting topic for further analysis. And then finally, some typical strategies that market participants kind of use in the market. If you want to play the range, what do? You can sell straddles or strangles, or you can do butterflies. So a butterfly is basically a combination of a straddle and a strangle. If you bought a straddle and sold a strangle, you would basically get a butterfly which looks like this, which basically kind of makes you money in a particular zone. As long as you kind of stay in that zone, you're basically going to profit. And again, the P&L that you make over there, or that you lose if you've sort of sold the butterfly, is kind of dependent on the implied volatility levels as well as the skew levels themselves. Other sort of bullish strategies. So we've looked at kind of selling protection. We've looked at outright receiver options. But you can also do what we call sort of payer spreads or receiver spreads. So receiver spread, as you can see over here, would be buying an at-the-money receiver, selling a lower strike receiver. You kind of make money as long as spreads are above the initial strike. You're going to start to make money, but then you kind of cap the amount that you might make if spreads continue to rise. So the reason why you might do something like that is you might think actually like spreads aren't going to go all the way down to like 20 basis points, so I'm happy to sell the upside if things continue to tighten, and that basically cheapens up the cost of the option that I'm buying today. Rather than doing sort of one of those, you can sell, you know, 2 in the money receivers. That cheapens it up even more, and then you start to get sort of receiver ladders like we see over there, and then risk reversals again are sort of selling payers, buying receivers. Between the 2 break-evens, or between the 2 strikes, shall I say, you kind of have a 0 P&L, maybe a little bit positive because you've received something, and then you kind of lose money or make money as you go outside of that range. So kind of combinations of different options basically allow you to kind of tailor the view that you're trying to express and express a bit more a sort of, you know, directional or qualified view. Same thing on the sort of payer side. You can have payer spreads, you can have butterflies, you can have payer ladders, you can have risk reversals, and all the rest of it. So, you know, again, just sort of various strategies that people employ in the market depending on what exactly their kind of view is, how much they're willing to pay for those options, and what they're trying to do. Again, you know, a bit of extra material that I think is on the website. Hopefully that stuff does work. And we will finish there and see you not next week, I think 2 weeks' time. I believe. Check the schedule. Hello. Yep. Let me just put this down a second.
So what we do is we buy, so we have to do.
So we buy the option.
Yeah.
Okay. And the option has a P&L prior to expiry. Okay? That P&L is basically determined by kind of the delta today as well as the sort of convexity, the gamma of that option. So the P&L looks something like that, you know. We were sort of looking over here, you know. As you go tighter, you don't lose as much money, but as you go wider, you start to kind of make a lot more money. So you do that, okay? Now you're at the money over here, so your delta is like 50%. So the index position that you do is effectively 50% notional. Okay? So the combination of that of selling protection and buying the payer.
Okay, so each time you gain a little bit by losing.
Yeah, if you make more over here, but you're losing less there. You make more over here, but you're losing less. You're making more than you're losing on that one. So you end up with this kind of like nice convex position, but then the cost of that is the kind of theta.
Oh, okay. Thanks.
Hello. Yeah.
I don't really understand because for delta is some percentage
Yep.
so what is
So this is a digital. So you've bought this one and you've sold that one. So you've bought a payer at 100 basis points, and you've sold the payer at 101 basis points. So you've bought this.
why do we use this method to see?
It's just a way of looking at it. So it's just basically so you bought something like that, and then you sold something like that. Okay, so between there, so the net result is basically something that just looks like that effectively. Okay?
So in this way, we want to see.
So that, because that kind of tells you because let's say that these are both like at the money, they're roughly at the money. So the difference between them basically is then like effectively the delta of the option.
The delta of the option at this point, or
The delta of the option at any level here is basically given by the value of
these two options.
of these two options. Yeah.
Okay. It's not
Yeah.
sense to see this, yeah.
So if you it's with anything. So basically the value of a digital option. So if I give you a digital option, so if I say like an equity option, that's let's say the underlying is at 100 today, and an equity option that's going to be at like 110. A digital over there, if you calculate the value of that digital, that's your delta today basically.
Okay, we can implement this method to any
Yeah,
valuation
basically,
of the data. Oh.
Yeah, it's basically just like a way of kind of calculating your sort of the delta of that option. Because it's basically what's it telling you? It's telling you the difference in price for this option versus this option. I.e., what is the value of 1 basis point changing? That's your delta.
Okay. So why is here not here? I mean,
Sorry?
um,
Whatever. Whether it's like that or like, I mean that's just that's your kind of cost there.
what can I use?
Yeah.
This? Things like is the DNF, so it will be like something like this.
Yeah.
So this is just enlarge it.
Yeah. And then you're looking at that distance there.
Okay.
Okay, which basically will give you something like like that. Okay, and what we're saying the difference in this option and this option is 1 basis point because that's spread, yeah. So we're doing like 100 versus 101. What's the value of 101 option versus the value of 100 option?
So we get.
And the difference in that's i.e. if spreads move up by 1 basis point, what's the value of our option?
So it's actually an estimation, right? Because you don't really know what, because if it moves up one.
Yeah, I mean it's basically it's effectively like a model independent delta. You're not even you basically it's just think like if I buy an option, what's the value of a 100 strike option? What's the value of a 101 strike option? The difference between those is the change in the value of an option for 1 basis point.
Okay. The idea is actually not that complicated.
No.
Yeah. I thought it's okay.
No. So it's basically just like what I buy here, sell there. That digital is effectively the delta.
Okay. Thank you so much.
And it's nice because you can do it for any. You can calculate your delta without any model. You just need to know the price.
Yes.
If you've got the price of one option, then
So
another.
can you call this realized data or something?
I mean, it's kind of it should give you the same as the calculated delta because ultimately, like the cost of the option is based on the delta.
Yeah.
So it should give you the same answer. But yeah.
Okay. Thank you.
Sure.
Have a nice evening.
You too.